Hello, welcome to Marketing Main Street. I'm Alex Rodriguez with Distinction Real Estate. Today I'm sitting with Isaac Stout. He works with Gilt Mortgage. We're going to be discussing Mortgage Lending 101, the do's and the don'ts when it comes to looking at purchasing property and getting all your financials set up to where, you look good on paper and we can pursue that property you're looking at. All right, let's do it. So, Isaac, Mortgage Lending 101. What are some things that just comes to your mind when you think of that, or when someone presents that topic to you?
Yeah, absolutely. First off, thanks for having me. Super good to be here. So kind of what we want to go over a little bit today is just the super basics of mortgage lending and what I do and how I can help, especially first-time home buyers and anybody looking to buy a house, or even just wanting to get a game plan together for wanting to buy a house in 3 or 4 years, whatever that is. But the basic things that I kind of wanted to touch, the first thing I learned when I got into this profession was what we call the 4 buckets of lending.
Okay.
And that just touches on, when first-time home buyer comes and sits down with us, or maybe it's over the phone, our first meeting, kind of getting a feel for their exact situation and what they're trying to do. So the first and main things we look at are, number 1, your debt to income, 2, your credit, 3, your assets, and 4, the occupancy of the property that you're wanting to buy. So pretty much the purpose of why you're buying a house. Is it going to be your primary residence, second home, investment property, what you're looking to do?
Right.
So,
right. Awesome. When it comes to, maybe your first time home buyers, or someone who, just needs, some more clarification, what are some things that you tell people or instruct people to do, not to do, when it comes to getting that first time pre-approval, or, wanting to go through the steps of, purchasing a home, or even maybe putting in an offer? What are some things that they can and maybe should be doing in order to, look good on paper and look good to, pursue
Absolutely.
that home that they're looking at?
Yeah. So the first step is getting yourself educated. What it's kind of a shame, but really the way, our education system is set up is there's not a ton of, when you're in school, high school, college, you don't learn much about mortgage qualifying and the upfront process of buying a house. So I always tell people the first step is get connected with a loan officer and a real estate agent that you know and trust, and getting educated. So the main basics are kind of what I went over: figuring out your income, figuring out the loan program that you're going to get into, or do you have money for a down payment? And then once you're in the process, there's steps to follow as well, as far as making sure you're being financially smart. And we always joke, I've had buyers before that, they're a couple weeks from closing on their house and they go buy a new car. And, that's the last thing you want to do, is be adding more debt to your situation right before you're buying a house, because we have to dive into all of that stuff.
Gotcha. When it comes to home buying, when is it a good time to purchase a home? How does that look from a lender standpoint? When do you guys typically tell folks, hey, right now is a good time to buy?
Yeah. Well, what's funny is I'm biased, obviously, because it's what I do for work, and I'm super passionate about home ownership, and I've seen countless times the long-term investment benefits of getting into real estate. So I tell people it's never a bad time to buy, because you're always going to wish you bought last year or 2 years ago. Yeah. But with that being said, there's obviously times, to try to time interest rates a little better, time the market a little better. Right now, where we're at is, home prices are still kind of down because rates are still pretty high. And what I tell people is, if you can get into a home right now, and if you can qualify and afford the payment, it's always going to be a benefit to buy, because when rates go down, which is pretty likely in the next couple of years that we should see rates at least a little bit lower, you can always take advantage of a refinance and get yourself into a lower monthly payment with the same house that you bought before. So,
awesome.
And as to go with that, as soon as rates drop, demand spikes and home prices go way up. You know what I mean? So when you buy a house, you have the guarantee that your monthly payment, no matter what, it's never going to get higher. You know what I mean? So if you can afford it now, it's a good time to buy, and there's potential to save some money later on with lower rates.
Different loans are out there. I mean, we're looking at conventional loans, FHA, USDA, VA. What are some things that, people can expect with, those different types of loans that are offered?
Yeah. No, you nailed it. I think, I don't know what the percentage is now, but about 70 to 75% of all mortgages that get done are called conventional loans. Those are loans that are bought and backed by the government, Fannie Mae, Freddie Mac. You probably hear of those agencies. So about 75% of all mortgages are done under those programs. But for first-time home buyers, there's a lot of 0% down programs that people like to take advantage of. That includes VA, USDA. VA is for, that's all done by the Veterans Association. I always tell people that's the best loan out there if you can qualify for it, but obviously, not a huge percentage of people that we work with are veterans or direct spouses of veterans. USDA is more for rural communities. So here in Kanab, lots of southern Utah, you can qualify for those programs. And that's also a 0 down, which is a great option. Something that we do a lot of here in Utah is it's called the Utah Housing 0% down.
Okay.
And that's for first-time home buyers who don't have a ton of money saved up, aren't able to come in with 3.5% to 5% or whatever the typical loan program requirements are. How that program works, it's an FHA loan. FHA loans typically require 3.5% down, which can be anywhere from 10 to 20 grand when it's all said and done, depending on the purchase price. But the state of Utah with this program comes in and gives you a second loan to cover that down payment, to where by the end of it, you're covering some prepaids and some fees, and you're, typically most buyers only end up having to come in with 2 to 4 grand when it's all said and done.
Gotcha.
Rates are super competitive on that program as well. So that's something we do a lot of here in Utah.
Yeah. And with all those loan programs, buyers are to expect an appraisal on everyone, correct? Yeah. And those are to be negotiated. Those could be negotiated between the buyer and the seller. They could be paid, by either the buyer, the seller, or even split between the two, however it's negotiated in the contract. But just correct me if I'm wrong, all those loan programs are going to have an appraisal attached to them, correct?
99% of the time. Sometimes when we get a home under contract and we run it through our system, and maybe there's a recent appraisal on file for that property, or if the purchase price is low enough that the system determines that it's really not necessary to get an appraisal. The only purpose of the lender getting an appraisal is to make sure that the buyer isn't paying way too much for a property that doesn't match the value of the loan, if that makes sense.
Yeah.
So if we determine it's all online through our system, but if the system determines that that home is certainly worth enough, sometimes we'll get what's called an appraisal waiver. Mm-hmm. And then you're not required to get an appraisal, but 95 to 99% of the time, there's going to be an appraisal that gets done.
Gotcha. You briefly stated that, if there was an appraisal done recently, I mean, what are we talking about as recently? 6 months?
Probably
a year?
Yeah. Very recent and without a major shift in the market, if that makes sense.
Okay.
Because maybe you got an appraisal done 3 months ago, but interest rates dropped 1%, and all of a sudden your home's worth quite a bit more than it was. If that makes sense.
Yeah. No, it definitely does. What other do-nots do you have as far as lending and whatnot when it comes to first-time home buyers or even just home buyers wanting to purchase a home?
Yeah.
We briefly mentioned having things to do as far as saving money and coming up with money for a down payment and whatnot. So you briefly mentioned, hey, don't go buy a car when it comes to, closing on a home, that'd be really bad. Are there any other little tips and tricks that people should refrain from doing?
Yeah, it's it's really a case by case thing. You know, what it all boils down to is, you know, the number one thing that we look at when someone's qualifying for a house is your debt to income ratio.
Gotcha.
So what's coming in, all the money that you're making that we can document, subtracted by all the money, you know, that's going out, and then calculating what your new home payment is going to be into that and figuring out what you can qualify for. So when I say don't go buy a car, you know, a month before you're closing or a week before you're closing, the reason I say that is because, you know, a lot of first-time home buyers, they're buying a house that maybe they barely qualify for. A lot of times those ratios are pretty tight. As soon as you add another $100 a month in debt, you might not be able to get that loan anymore, and it can kill the whole deal, and you might lose your earnest money. So that's the main no-no. Don't want to be getting any new credit cards, things like that, and just, you know, making sure that you're following the necessary steps that your loan officer's kind of giving you, making sure you sign all the documents necessary on time, and getting your loan officer and his team or her team everything that they ask for.
Yeah.
People are always asking me, you know, when they're getting pre-approved and maybe putting in offers, how quick can we close? How quick can we close? And I always tell them, I can close as quick as you get me everything. You know what I mean? Like, if you're going to get me all your documents super fast, we can close this in 3 weeks.
Building credit. What are some tips on folks to build their credit?
Yeah, no, absolutely. This is something I'm fairly familiar with recently. Me and my wife actually just bought our first house, and
Congrats.
We got married, and we're starting to look into it, and I realized she has no credit. She's never borrowed any money. And it's kind of frustrating the way credit works, because it's another thing that we're not educated on. And, you know, a lot of people, as soon as they graduate high school, they'll go get a couple credit cards and max them out in college, and then they're trying to rebuild their credit score for the rest of their lives. The main thing is no late payments. If you're going to borrow money, make sure that you never have a late payment, and you're going to be just fine. Another thing is constantly having your credit cards maxed out. That's the number one thing that, you know, when people check their credit and scores are super low, that's usually the reason, is because you have a credit card with a $3,000 limit and the balance is $3,000. That's something that really kills your score. And what's nice about that is it's an easy fix. You pay that $3,000 down to $1,000, and your credit might boost 40 points in a week. You know what I mean?
Yeah.
So main thing is staying away from late payments and staying away from bad debt that you're not going to be able to repay.
Right.
So
for someone who doesn't have credit,
yeah,
do you recommend going and getting a credit card, or
absolutely
borrowing some money somewhere and kind of getting on a schedule to making payments and kind of building that credit? What do you recommend?
I would say the first step, go to your bank and get the simplest credit card option that they offer, and use it for gas or groceries or whatever, and pay it off, you know, and keep, you know, never more than 20% of the max balance on that card, and you'll be amazed how quick that'll boost your credit. Other quick things that we tell people, like they're trying to get a loan in a few months and they have no credit. A lot of times, if maybe your mom or dad or someone that you know, your spouse, whoever it is, if they have a credit card that's been in good standing for a little while, you can go to that bank and get put on as an authorized user. Oh. And a lot of times that credit history that's associated with that card will immediately jump onto your credit, if that makes sense. So
that's good to know.
That's like for whatever reason, sometimes that doesn't always work, but 75% of the time, that's something that can really quickly boost your credit. So, but it's a matter of all of these things. It's just a matter of making sure that you're educated before you pull the trigger on anything, and understand what you're getting yourself into. So,
Isaac, property types that people are typically looking at. You know, we have your residential, you have your townhomes and condos, you have your vacant property and your commercial property. At Gilt Mortgage, what do you guys take care of, or is there a property type that you guys prefer over others? How does that work with you guys?
Yeah. With my company, Gilt Mortgage, everything we do is residential. We don't break too far into the commercial space, and that's kind of governed separately. But yeah, basic property types, like you said, is your typical single family residence, stick built home. And then also you have townhomes, condos, manufactured homes. Those are all, lending requirements are all a little bit different. Townhomes are super easy. They're governed the same way, the rules around those are the same way a single family home is. Condos is where things get a little bit tricky as far as financing goes. A lot of people don't realize the difference between a townhome and a condo because, it's all, a lot of times you'll have a community and all the units are attached and, you think it's a townhome, you think it's a condo, but a lot of people don't really know.
Yeah.
Townhomes is you're buying the unit and you're buying the land that the unit sits on. That's why they're pretty easy. Condos, the way they're set up is you're buying the unit that you're going to be living in, and you're also buying, instead of the land that your unit is sitting on, you're buying a percentage of that condo community.
Gotcha.
Does that make sense?
Yeah.
So that's, for whatever reason, that changes the lending requirements. And that's why every condo community, I live in St. George and there's a ton of different condo communities. Every condo community has to have a specific approval with whatever loan program you're looking into. So anytime someone sends us a condo that they're looking at, we have to go through the system and say, okay, what loan program are these guys doing? Are they conventional? Are they FHA? Do we have an approval in that community? And to determine if we can finance the unit.
Okay.
Does that make sense?
Yeah, no, it does.
And then something that's becoming more and more common is manufactured homes. Used to be really, really tricky to get financing on manufactured homes, double wides, modulars, single wides. Double wides and modulars are all super easy now. The requirements aren't nearly as strict. It's, a lot like, as long as, I guess one thing to say, any manufactured home built before 1976 can't be financed. So that's one thing to keep in mind. But anything after that, which is a majority, is pretty easy. When you get into single wides and park models, those are a little bit more tricky because you'll run into a lot of communities is more in like a trailer park communities where you find a lot of those single wides. And a lot of times the land is all owned by one person, and people can just come in and buy the units. Gotcha. You can't get a loan if you're not buying the land itself that the unit is sitting on. So that's why those properties can be a little more tricky, but we're always happy to work with people and, make sure people understand the options and the difference between it, because it can get a little bit confusing. Yeah.
Okay, so closing costs. We mentioned and talked about appraisals. What are some things that could help buyers out with their closing costs from the bank standpoint?
Yeah. So just a little overview on closing costs and what they are. There's different fees and different people involved in the loan process that have to get paid. And that's what makes up most of your closing costs. The title company has to get paid. The underwriter has to get paid. There's no fee that goes directly to the loan officer, and obviously the real estate agent is paid out of commission, and that's kind of separate from the loan process. But those title fees, underwriting fees, paying for your appraisal, and then one thing to hit on that's a little bit tricky to understand if you're not sitting in front of the numbers, but when you buy a house, there's what's called an escrow account, and that's what your property taxes and homeowners insurance are paid out of at the end of the year. So there's a 1/12 of your yearly property taxes and your yearly homeowners insurance is collected each month as part of your mortgage payment, and that money's held in an escrow account, and the servicer of your loan pays your property taxes and your homeowner's insurance at the end of every year. So typically, when you're buying a house, they collect 3 to 6 to 12 months of all of that up front, depending on what month of the year you're buying your house in, if that makes sense. And that makes up part of your closing costs as well.
Okay.
And there's different fees for different loan programs. The VA's fees are a little bit different. Utah Housing's fees are a little bit different. And as you're deciding on, it's nothing major, but as you're deciding on what loan program fits you best and sitting down with your loan officer, that's something that you'll want to really dive into to just so people understand it. And one really awesome thing that's happening in the market right now that we wanted to touch on was the ability to negotiate seller paid closing costs when you're putting in an offer on a house. So that's something that we try to educate and help people negotiate. So for instance, if someone, your typical first-time home buyer, say they're buying a house that's $400,000. The house is listed at $400,000 up front in their offer. Maybe they don't want to offer full price. They want to offer $380,000. But maybe they want to try to cook some of their closing costs into the loan or into the contract, if that makes sense. So for instance, instead of offering $380,000, you can offer $390,000 on that house, but on the back end of the contract have seller is going to provide a credit for the buyer of $10,000 to go towards buying down your interest rate, covering your appraisal, covering those other closing costs that we went over. And that could be a huge tool for first-time home buyers, just so that the money coming out of your pocket stays in your bank account for a rainy day, if that makes sense.
Right. So. No, that totally makes sense. And if the roles were changed, the market was more of a seller's market, and sellers had more ground to work with.
Yeah.
If negotiations were to take place, and there wasn't really much room for the buyer to play with as far as the price goes, they could potentially, still talking about that $400,000 home, if they wanted to intact those closing costs with the purchase price, maybe offer $405,000, maybe $410,000, and say, hey, you're still going to get your $400,000, but I want this extra or this additional $5,000 to $10,000 go towards, my closing costs, my appraisal, my home inspection, whatever, but it's coming out of the seller's
technically
concessions.
Exactly. Yep.
Gotcha.
No, that's something that we do every day.
Yeah.
Like most deals that I've done in the past year or two, there's been some sort of seller credit involved.
Right.
And it's really just an awesome benefit to the buyer.
Yeah. Awesome. When it comes to purchasing a home and, taking advantage of some of these programs and credits that we have available, correct me if I'm wrong, Isaac, they have to be the primary residence. The home has to be a primary residence for those buyers in order to take advantage of those programs and credits and stuff, correct? Yeah,
so that's something I should have touched on when we were kind of going over it. But any of those minimum down payment programs, FHA, conventional 5% down, conventional 3% down, Utah Housing, USDA, VA, you can't do any of those programs if you're going to be using the property as an investment, if you're going to be renting it out, or if it's going to be a second home that you're only in 3 months out of the year. It always has to be for your primary residence. What determines something being your primary residence is if you're committed to living there at least 6 months out of the year.
Gotcha.
So, which pretty much keeps you from being able to have two primary residences, right?
Right.
So I guess 6 months and a day out of the year is what the requirement is.
Okay.
So.
Well, that concludes our topic for today.
Yeah.
Again, thank you for your time and coming over and speaking with us.
Cool. Yeah. Hey, thanks for having me, Alex. If anybody has any lending questions and questions that came up on what we discussed today, or anything else, want to dive deeper into mortgages and how it all works, feel free to reach out to me anytime.
Thanks again for being here. I'm Alex Rodriguez. Don't forget to comment, like, and subscribe to keep up with everything real estate.